Good afternoon for the latest edition of the Jack and Bill Show live Friday afternoon from Shreveport, Louisiana. Shrevesville, yes, it's a beautiful day outside, but about to get nasty again tomorrow. I think it's about 73 degrees and blue skies. And we've had an interesting day. I went downstairs to get a cup of coffee while you guys were at lunch, and the market was mixed up slightly, something like that. And I look on the TV set downstairs, and it threw me for a loop because we were down, call it roughly 2% on the market in about 10 minutes. And that is because the White House made a press release, and they are urging all Americans to leave the Ukraine immediately. They wouldn't get into intelligence, but they feel strongly that here during the Olympics, probably next week, Russia is likely going to invade. Is Kiev the largest city over there? Do you know?
In Ukraine?
Yeah.
Yes.
Yeah, and I think that's where they're going. They've warned
Kiev.
Kiev. Okay, I've said that wrong. What about? So that's not
in the West. We mispronounce it.
We mispronounce it. Kiev. Okay. So they had already. Now Crimea, that island is part of Ukraine. That's part of Russia now again, is it not? Yeah. So they did that. They were able to do that rather peacefully, but the White House warning that this is likely going to be bloody and horrific. And with that, West Texas Intermediate prices went up $4.20 a barrel. You'll feel that at the gas pump if you fill up tomorrow. $94.12 a barrel. That's up nearly 5% in one pop. And if they do go into Ukraine, expect nat gas prices to go way higher, especially during this winter cold weather season, and West Texas Brent crude oil liquid prices going much higher. So the NASDAQ went down 2.78% today, back into the January theme, Bill. These low dividend paying, high PE growth stocks underperforming the S&P 500, and especially value stocks, low PE stocks, banks, airlines, industrials, things like that. Bitcoin taking a hit, 42,500 a coin, down 2.8%. Gold rising sharply, Bill, here in the last hour to 1863 an ounce.
Yep, gold likes geopolitical risk.
That's right, up $25 an ounce. So when I look at yesterday's Wall Street Journal, the S&P 500 had climbed its way back to negative 5.4% on the year after last year's hugely profitable year. This puts us now down, call it 7.3% on the S&P for the year. A couple of percentage points less on the Dow, roughly. A couple of percentage points more on the NASDAQ. Russell 2000, this is a little bit surprising, only down about 1% today. So I think we have a treat for you today. We really kind of want to talk about the consensus with what's going on, what's kind of rattled the markets this year, what's going on in the bond market. What is the bond market foretelling us? And I think Bill has a really good handle with that. And then we may offer we're going to offer the contrarian, side to that as well. And okay, Bill, take it away, brother.
Well, when you said, okay, a handle on the bond market is an important source of information, especially when it comes to interest rates and inflation and expectations of rates and inflation. Having said that, did the bond market accurately predict the levels of inflation that we have now?
Is that a question?
That's a question.
No, sir.
It did not. It did not. So the bond market, we like to say, is the adult in the room. The bond market globally is the largest market. Well, bonds and rates. But we say that it is the grown-up in the room compared to the stock market. But the bond market does not always get it right. And the bond market, did not foresee CPI hitting a 7.5% print like it did this week. So that's out of the way. The bond market right now is giving us some indications that appear to us as saying that inflation is not a longer term concern. There's economic data that we can look at to support that, but it doesn't mean that that's going to be the case. But we do know this. We do know that financial conditions are tightening. On the fiscal front, we do know that fiscal support is going away. Child tax credits, all of the fiscal stimulus that came out of Congress during the COVID lockdowns, that's going away. And we know that the Fed is they're about to embark on tightening monetary policy. They've stated as much, and we're expecting the first rate increases to the Fed funds rate next month. So financial conditions are tightening. We are expecting declines in manufacturing activity based on data that we're seeing. We are seeing global shipping rates on the decline. We've seen a spike in business inventories, which is interesting, which could mean a couple of things or both. I mean, it could mean that supply chains are normalizing. It could also signal that the business cycle is unstable. Or
Could be hoarding in some circumstances.
Or it could be both. We are seeing orders backlog surveys declining.
Mm-hmm.
We're seeing consumer sentiment surveys declining. Small business optimism surveys declining.
Those are leading indicators.
These are leading indicators. And so when you take all of these combined, it does not paint a very rosy picture for economic growth going forward. Those are economic surveys. Then we look at what the bond market is signaling. We have seen the yield curve, which is a graphical representation of interest rates over time. We've seen the yield curve, which is normally upward sloping, flatten. And it's likely to invert if the Fed is aggressively tightening short-term rates. An inversion is when short-term rates are higher than long-term rates. The market right now is expecting 5 to 7 1/4 point rate hikes this year. It's possible that the Fed may lead off next month with a 50 basis point hike. Who knows?
It's that became with the CPI print that came out yesterday. That probably became a
higher probability,
and that hasn't been done since 2000, I think, 21 years ago. Yeah.
And a good gauge of where the Fed funds rate should be is the yield on the 2-year Treasury, which is 1.5%. So normally we say a very, very high correlation between the 2-year Treasury yield
where
and
the Fed's going to take it.
Where it's going to take it, yes. So, the expectation of 5 to 7 1/4 point rate hikes, makes sense, especially when you look at where the 2-year Treasury yield is. Now, having said all that, we can also see that the bond market is signaling that even though the Fed is on the path of tightening and raising short-term rates, when you look at the implied Fed funds 3-year forward rate and subtract from that the 2-year forward rate, that's indicating that the Fed will be cutting rates an 80% probability in the year 2024. So what the bond market is signaling is that the Fed will tighten. The Fed is behind the curve in tightening, and I think everyone agrees with that. And there is a risk that the Fed is tightening into an economic slowdown and could push the economy into recession. not this year necessarily, but at some point in the near future. That's what the bond market is signaling right now.
Okay, no, that's good, Bill. And I think one of the misnomers that we're seeing, and one of the things that kind of, concerns me, I've looked, I just recall if you go back decade after decade and look at the survey of the leading economists or the guys that get to make these forecasts, something like 2 times out of 3, they get the direction of interest rates wrong. And so, but the thing about it, from our standpoint is where can the money be made? And the other thing you have to be careful about is like reading research reports for stock market companies, that's called sell side research. And you're hardly ever really going to see the truth on something like that. If the company writing the research, brought them public or does capital market transactions for them, secondary offerings and so forth. The same is true, with the bond market. You've got sell side bond market analysts that write about this stuff, because their firm manages money in the bond market and they want you buying bonds from them so that they can earn management fees, and then buy side research as well. And
you know what that reminds me of?
What?
It reminds me of the story from David Rosenberg, famed strategist and economist. And before the credit crisis, he was turning increasingly bearish on the markets and the U.S. economy. And he was one of the top economists at Merrill Lynch. And and he said
Absolutely.
he had to leave. He said, how can you be bearish at a firm that has a bull as its logo?
Yeah, the bull in the china shop. And the day he got bearish, he knew his days were numbered. Correct. So you have to be, it's kind of like, hope no one out there's a used car salesman. It's kind of like
good money right now.
They are making really good money. It's interesting, read in the Wall Street Journal this week, kind of going on a rabbit trail here, but Ford and General Motors have said that about 10% of the auto dealerships in the United States are gouging customers on used car prices, and they said that their inventory of new cars is their allocation in the future will be subject to great declines if they continue to do that. And they also stated that they know who they are. So that's really kind of interesting. But so this is the thing that Bill was saying, and I think that there are some assumptions that are being made as well, that, and just to kind of quantify that, when Bill was talking about the slope of the yield curve. So if you buy a 3-month T-bill, if you're comparing yields on a 3-month T-bill versus a 2-year note versus a 5-year Treasury note, once they get past 10 years, they're called bonds. You would expect to be getting more interest the farther you went, because
paid for the time.
To get paid for the time. So that's what's really a normal yield curve. However, we did see in the Volcker days, which could be Paul Volcker was the Federal Reserve chairman, and in the mid 70s through 1980, I think the peak was March of 1980. And this is just off of the top of my head, but I think the Fed funds rate got to about 16%. And I think the long bond was trading at about 14.5, Bill. If you had bought the long bond, then you made 30% annual returns, for years. And as the economy improved, and Volcker's stance on inflation was dramatic, and he took care of it.
So I'm going to interject here. I was talking to a client recently who back then was buying treasuries and remembers vividly at that time, inflation was so rampant and rates kept going higher and higher. And we've talked about this risk of extrapolation. And she was saying how, no one wanted to buy long treasuries then because they just assumed that rates were going to keep going higher and higher. And
you could leave your money in a money market.
Exactly. Yeah. And in hindsight, what you said is so true. I mean, if they had just locked in those long treasuries then and not taken the bait that it's just going to keep going higher and higher, they would have, a huge return.
Yeah, exactly. And so the last time we inverted, most recently, I think we've only inverted once since around 1994, and I think we got to, if you compare the 30-year minus the 2-year note yields, the historical average is just about a 2% differential, or 200 basis points, and the lowest we've seen since 1994 is negative 0.2. I think that may have occurred in 1994. So, but Wesley, can you show the slide with the asset class returns on there? Let me know when they're, if it's on there.
Which one would that be?
That's the one with equity REITs, large caps. This one here.
Oh, okay, that one.
Yeah. So, you have that up there.
Yep.
Yes. So as you can see, this is give credit where it's due. Roger Ibbotson and Associates, Stocks, Bonds, Bills, and Inflation. They've tracked all this stuff from 1926 to present. And I don't know, do we have those numbers? We don't have those circled on there. But look
yes, we do.
You do. Good. Thank you. The inflation number is 3.8%. That's the same. That's the CPI, Consumer Price Index, which means that that's a general rise in prices from 1972 to 2020. Inflation has averaged about 3.8. Now, if you go all the way back to 1926, it's closer to 3%. But this is really because it's including the high inflation periods of the 70s and early 80s. But look now at intermediate term government bonds, and you say that they yield 6.8%. Well, so you could take this sheet and say, well, I'm going to buy intermediate term government bonds because over a long period of time they make 6.8%. But actually, call that 10-year treasuries. They yield about 2% today. So that's very problematic. And that 6.8% number, if you go back to 1926, it's more like, let's just say 5.5%. So it's fair to say that if you buy bonds, you want to, in order to make money and move forward, if they're in a taxable account, you have to pay taxes. So in order to stay ahead of inflation and earn a significant real return, the real return is average 3%. But what do we have today? So CPI inflation just hit 7.5 yesterday. So if you add that 3% to that bill, you'd have to get 10.5% on a treasury to average, to work out to the normal relationship we've had since 1972. Or let's state this another way. If today's yield is about 2, the real return on that would be minus 5.5%, because you're getting 2, subtract out 7.5% inflation, and you're moving backwards by, essentially, you have a negative real rate of return of 5.5%. You could quantify that this way. In fact, I just heard this, I think it was from Larry Kudlow. He's on the screen right there, about a month ago. He's a neat guy. I like him. If you buy a 10-year treasury today paying 2%, you could liken that to paying the U.S. government 5.5% for them to loan you money at 2%. Because I saw this go across the screen today. The average consumer in America is spending $250 a month extra because of what inflation has done. And now, while the Fed I think they've known this all along when they said don't use the word transitory anymore. I think they've intentionally been behind the curve. Show them this one, Wesley. Okay. This is actually the fiscal state of the nation. And you can look under here under the column surplus / deficit in 2008. That's kind of in the middle, right before the colors. The worst deficit that we had the last year under George Bush was $459 billion. And that was dramatically higher than the prior year. And the very next year, it went up fourfold to 1.4 trillion the first year under Obama, but he did inherit the subprime mess. But now fast forward to last year, and that more than doubled to 3.1 trillion. And over that same time period, we've seen our debt to GDP climb from 68% to 150%. So one of the reasons that the Fed and the money driving Washington decisions right now could be a secret plan. If you could think the rule 72, divide the number of years it takes to double your money, divide the interest rate by the number 72, and it's the number of years it takes to double. So let's just say it's 10%. It would take 7.2 years. If inflation ran at 10% for 7 years, call it, that would have the effect of slicing our national debt, in half. And some people actually believe, that's because it is a written mandate of the Federal Reserve to have stable employment and maximum employment and stable prices, typically meaning 2%. I think there's a third unwritten mandate, Bill. You want to share that?
Well, I mean, let me just go back to what the assumption for discussion purposes of 10% ongoing inflation. I mean, that flies in the face of the mandate of stable prices.
It does. Well, so there would be a violation of that mandate. Yes, I mean, but a lot of people think that the Fed has gotten politicized, and So anyway, so let's get back to where we were going with this. Is that, and we're going to get Wesley didn't make a chart of this one. The producer price index, wholesale prices, has been running at a steeper rate, actually 9.7% inflation. And we get that print on the 15th. Is that Monday? That's coming out. I think that's Tuesday. Okay, Tuesday. So yes, go ahead, Wesley. Yeah. Show them the next one. So this is kind of the CPI. Go ahead, Bill.
I saw bond guru Jeffrey Gundlach on TV today, and he's been pretty accurate over the years in his prognostications. He has the belief that U.S. CPI will end the year at around 5%. Certainly less than the 7.5% that just printed, but still above the 2% Fed target. So if we do see that, he could be wrong, but if we do see that, I mean, that is a peaking of inflation. But he pointed out something that was very interesting, and that is this notion that we could see a rotation of the drivers of inflation. So previously, the big drivers of inflation were related to supply chain disruptions and an increase in consumption demand. And going forward from here on, because if the economy is in fact slowing because financial conditions are tightening, well, we could still see energy at high levels, sustained high levels. And then we have this risk of wage growth, wage inflation. And we do know that wage inflation, unlike some of the other causes of inflation, like supply chain disruptions, is sticky. And we've talked about that in the past. So these drivers of inflation could be changing right before our eyes. And so inflation could reasonably stay high for longer, even though it is trending or is in the process of trending down from 7.5. I mean, it could even tick higher.
Yeah, I think I would give that scenario a very significant probability. But I think, when do you have the CPI up there, Wesley?
I do again.
Okay, it's highlighted. Look at the ones that are highlighted in green. There's a phrase they say that the trend is your friend until it ends. And trends generally last longer than people realize. And it's my opinion that this very well may be one of them. So we had you would think that the surprises would stop. This was a significant surprise.
It was.
And I do think that I am hopeful and believe, like Bill Gates said, that by July, this pandemic thing may be fizzling out. And so we get an opening of the economy and supply chain disruptions go away.
That may depend on government.
Yes, it could. Yes, it could. And I've heard all kinds of things from intelligent people that this government wants high inflation and high oil prices. If we can get, if Russia goes into Ukraine next week, oil prices could easily spike to 100. And then we could have more giveaway plans, from the government for this is most impactful, this $250 a month for lower and middle income people who now I'm reading it this week in the Wall Street Journal, fewer and fewer people can afford a house because home prices have skyrocketed. But there's more to it too, Bill. If you look at Wall Street Journal article today, in Pennsylvania yesterday, I used to buy my groceries at Giant. It's a Giant food store grocery. Somebody in Carlisle, Pennsylvania stole all of their beehives in the last week.
What?
Yes. And did you know that honeybees pollinate 1/3 of all the vegetables in the United States? Then you think of like hurricanes that went through the Gulf and destroyed the oyster beds, and we had oyster inflation, or the blue crabs got knocked out. There's more crabs than oysters, pardon me. Oyster prices skyrocketed for a while. Blue crab prices. Jumbo lump is way higher, like 100% higher than it used to be. So there's some weird things happening, but I think the biggest thing, Bill, for the long-term picture here is the picture of demographics and labor. Unit labor cost increases are 2/3 of the inflation game. And then, commodities are a huge part too.
Sure.
And we've got an aging population with a lot of people leaving the workforce. And that's counteracted by, you've shared this with me before, innovation in technology, automation, things like that. But
that reminds me, because, one big factor in this whole inflation discussion is the supply chain disruptions that clearly happened and are still ongoing. And as I said, it does appear that we are seeing some relief to that. In fact, I saw something about how there have been fewer mentions of supply chain backlogs in S&P 500 member earnings calls. Isn't it funny how they actually measure mentions of that in calls?
Yeah, really.
But what are we seeing now? Okay, right now we're seeing these trucker strikes in Canada.
Protesting.
Guess what that does to supply chains? And one of the biggest gateways for trade between the U.S. and Canada is in the process of being blocked. And there is talk about U.S. truckers doing the same thing here in this country in response to government COVID overreactions. So things like that could further exacerbate the supply chain disruptions.
And I think we're kind of wrapping it up, but I think what kind of implications can we make from this? And I wanted to make one or two points, and then implications. What are we doing? I think one of the things that we get from these, buy and sell side or economists that have been writing about this stuff, Bill, is there's an assumption that if we go into recession, I think that's very possible later this year, especially with an invasion of Ukraine during the Olympics.
Yep.
What an opportune time for Putin, or any kind of weird things that could happen, geophysical or things like that. But this notion that if we do go into recession, that's actually a cut it with a meat axe way to define that. Most economists are way more sophisticated than this, but you could say 2 quarters in a row of GDP declines. Okay. So GDP growth, that's all goods and services in the United States domestically. You see a decline from 1 quarter to the next quarter, and then another decline. We had sharp declines with the start of the pandemic, but that was actually mandated and brought about by government mandated shutdowns. Yes, I'm being redundant. So here's the thing. So if you get slowing economic growth and you go into a recession, Bill, there's an assumption by a lot of these prognosticators that means that you're going to have lower inflation. And I'm just going to say,
a fair assumption.
It is a fair assumption.
That's been the case.
It's historically a fair assumption, but many people think that we're in the midst. I did a client review this week with a very astute gentleman who was showing me a report from Goldman Sachs that we're in a commodity super cycle. I just mentioned food shortages. Look at all these pigs that got wiped out in flooding and disease. The beehives, the vegetable stuff, the drought in California, all these weird things that seem to be culminating potentially in a possible perfect storm. And then you've got aging people that are leaving the workforce, and many of them who just said, golly, I don't want to go back to work during this pandemic and catch COVID. I'm in my 60s or 70s, and some of these people have permanently left. I think in the last job report, there were some that came back and did the opposite. But so I'm not so sure that slowing economic growth dampens inflation with what we're seeing. I think a lot of this stuff you could call in commodities, you could actually call this cost push inflation, rising in prices of raw materials, or you could actually call it stagflation.
Yep.
So that is a stagnant economy at the same time with rising prices, which is especially harmful, to the American people and people around the globe, and especially people in emerging markets, as well. So do you have a point to make with that?
Yeah. No, I saw this graphic this week, and it really caught my eye. And it's showing global inflation rates around the world. And so here we have the U.S. at 7.5%, compared to developed countries around the world. It really does look like an outlier. And the country, the developed country with the lowest year-over-year rate of inflation is Japan at 0.8%. Now, what's interesting about that is, compared to the U.S., Japan is energy dependent. They don't have the natural resources that we have. They have had an aging population problem, worse than the U.S. Their debt to GDP is worse than in the U.S. And yet their inflation is at 0.8%. And I think about the quote from Milton Friedman that inflation is always and everywhere a monetary phenomenon. And it is interesting that we've seen that with growth in the money supply and increased debt, that it really hasn't done anything for inflation And this inflation that we have seen really came about just in the last year. So that's why.
Well, what if I would suggest, what if the things that the monetary inflation that you just mentioned, that could be a potential underpinning for this stuff that we're seeing now. And but that's a very nice point, and I don't have an answer to that.
Yeah, I mean, other countries like France, their CPI came in at 2.9%. Germany 4.9. You know, Mexico.
No, those
Mexico's rate is 7.1. We have higher inflation right now than Mexico.
Yes, Bill, but 5. Anything above, okay, the average of all these nations is going to be way higher than what I would call normal. Okay, normal is 2%, something like that.
Oh no, the average right now is above normal. No question.
Yeah.
No question.
So that is so that's the thing here, and here's an implication. When you look at these, so short-term yields go up, the 2-year Treasury notes forecasting or predicting that, and the yield curve is flattening. It is flattening at this moment. Actually, it's steepened greatly this afternoon with the idea that Putin's going into Ukraine, because we're not, if World War III starts next week, the Fed's not going to be tightening.
No.
Right.
No.
Okay.
No.
So we would go back, to a steepening stance there. But the thing about that is, so you could even have, I've seen under Volcker, they could raise, short-term rates and long-term yields even go down, because there's a confidence in the American people that the Federal Reserve chairman and their team are very serious about inflation, and it's working. I happen to think that our Federal Reserve, we're still doing QE, by the purchase of treasuries from people like us and institutions, and they haven't even stopped doing that, which makes no sense to me. And I actually think that's inflationary, as well. So are there opportunities in buying long-dated bonds with a flattening of the yield curve? And the answer is, if you buy a 10-year Treasury at 2 and rates go to 3, you lose about 9% of your principal amount if it happens quickly. If it goes to 4, you lose 15 to 20%. So, the opportunities are on the contrarian side of this trade, and how to do that. So I'd just like to throw in there too. We said the trend is your friend until it ends. We are heavier than most. I think the makeup of the S&P 500 of energy, for example, is about 4%, down from peaks of 15% or more. We are much higher than that. We think this keeps on going. We have a bias towards value stocks, low PE stocks, high income paying adjustable rate securities, high paying dividend yielding stocks, companies that trade at very high multiples of free cash flow to enterprise value. And so our clients are positioned to take advantage of this, whichever way this goes.
Well, and it doesn't have to continue for energy and natural resource companies to stay attractive. They're too cheap relative to the broad market. So commodity prices, could peak and turn lower from here, and these will still remain good investments.
So we say the inflation trend right now is alarming, and it's the most important thing to watch, because it's going to determine if the Fed is going to be left with a choice. And the big question in the room is, how many tightenings can they do without upsetting the stock market?
Yes.
And then who are they going to favor? The wealth effect from the affluent that owns stocks, or do they keep the pedal to the metal, crater the stock market to try to help the little guy who can't pay for bread and gasoline.
They're walking a
So-
fine line here.
Though these are the biggest implications, it's what made the market decline in January. And this is something that we're watching very closely. If you have any questions, please write in or give us a phone call. But I thought I would ask, Bill, if you, in conclusion, if you wanted your son to be a Super Bowl quarterback, what would you name him?
You have a son? Super.
That's a serious
It's a-
question.
So you're saying that you're saying that the kid's success is dependent upon his name?
Absolutely. You would have to name him Joe.
Historically speaking,
Hmm.
people were named after for success.
Yes, we have Joe Montana, Joe Namath, Joe Theismann, Joe Flacco, all playing in the Super Bowl. And the newbie to the crowd, Heisman Trophy winner, LSU national champion, Joe Burrow. So there's going to be, if Joe wins the Super Bowl, a lot of people are going to be naming their son Joe. And we'll leave it with that. Super Bowl this Sunday afternoon. The line is 4.5. It's a home game for Los Angeles. Not very good for the hotel business because all the Los Angeles people already live there. But there will be some people traveling from Cincinnati and other
As you
places.
said earlier, the trend is your friend. Go Joe.